Alrighty, welcome. Chris Lester here. I'm going to be your presenter today. Today's topic is, quarterly outlook. Looking forward, I asked Mark DiOrio, who's our Chief Investment Officer at Brookstone, to help me to present some data. He had recently done a presentation for a lot of the advisors at Brookstone. So I took that data, and then that's what I'm going to be sharing with you here today. It's just forecasting, right? So, we don't really know what the future holds, but we can make reasonable predictions based on information. So if you've not been on this call before, welcome. If you have questions after the call, please reach out. I'll have my contact information and we'll go from there. These calls typically take 15 to 30 minutes, and I try and present different information, different topics and subject matter so that I continue to provide value to you all so you guys sleep better at night. All right, so without further ado, quarterly outlook. We're going to go through about 8 slides, 10 slides, and there's a lot of information. I know you're not going to get it all, but the column all the way to the left, which is the first quarter of 2022, shows that the financial markets, both in the equities and in the bonds, had a negative return for the year, right? And most of you, if you have any money in the market, probably have realized that. The only area that had any green was commodities. That's down here at the bottom, right? If you can see my mouse. As we go forward, obviously, that's where I have the expression averages lie. We're not in the market for 1 quarter, 2 quarters, 1 year, 2 years. So you'll see that over time, things will recover. But what does this mean, or from an adjustment standpoint, should we be making adjustments to anything? So let's look at some of the data and what it suggests. The first is, and I have to minimize this, is that the consumer price index and the producer price index, which are measurements of inflation. Right now, I don't need to tell you, you're all now aware of it. What I've been concerned about for 10 plus years is that inflation, with the spending that's been going on, was coming. It is now upon us, right? And you can see that on both sides of it, both from when we go to the grocery store or the pump or any of those things, and manufacturers, right? As they try and collect materials to provide goods, they're paying more. So that is all being passed along. But what this means for the Fed, the other area is that the Fed has started to raise interest rate. That's usually a mechanism. That's one of the levers that they can use to slow down inflation. However, the landscape is really different than it was even 3 months ago. Right now, you'll see that the Fed will try and bring up their borrowing rate to where in between where a 2-year and 3-year yield is, right? That's that arrow that's in the middle of the screen there. But the challenge is that there's already an inverted yield curve here, right? So because we have inverted yield curves, what that typically suggests is that we're already starting to slow down growth and therefore inflation. So it's not a panic moment, although things are going up and have gone up and probably will continue. We see it in mortgage rates and things of that nature right now. The sky is not falling. So I just wanted to share that. Now, this is in the upper left-hand corner, retail sales has been red hot, right? So this was good news, growth and everything, consumer confidence, everything was going along fine. One of the things and points to observe, though, is that the savings rate has actually fallen back to pre-pandemic levels. It's actually, Americans now have started to spend or slow down on their savings. So, that is typically not a good sentiment for the markets in general. Now, another leading or contributing factor is oil, right? These oil prices that we see in the upper left-hand corner are at where they were 2011, 2014, at $100+ a barrel, right? And number of factors. But what that has started to do is it's actually, and this was good news, is it started to encourage in the lower left-hand graph here, US rig counts, which means that more of our rigs or oil rigs are actually starting to produce oil as much as possible. So hopefully stem some of the costs at the pump. Now, this slide here, the consumer sentiment, right? This has gone into a tailspin. And this is because things are more expensive. Houses have become more expensive, cars have become more expensive, mortgage rates are obviously in that factor as well. And it's been a nosedive. And that right there is part of, the sentiment when we do our recession probability analytics tool. Part of the calculations that are put into that are consumer sentiment. So you'll see here that there's actually a silver lining. And what does that mean? So our unemployment rate is really almost at unseen lows, right? So with unemployment rates so low, but the job demand so high, what this suggests is that our markets are not ready to roll over. So it doesn't mean that we won't have some more challenges on a go-forward basis, but there is a lot of demand for employees and a short labor force, which actually is good for the economy as a whole. Now, as we turn to stocks, right? Typically, as we enter into inflationary areas, we want to start to shift from growth-based type stocks into value proposition type stocks. Or, I've done my pieces in the past, milk cows, and way to create income. But value stocks are typically, I'll refer to them as aristocratic stocks or dividend paying stocks that have a history of paying, strong earnings to people that want to collect some type of income from that capacity. So that is, good news. And we've seen in the past that, when corrections in the growth market start to happen, inflation starts to happen, there is a flight to value, and that would probably be suggested from a asset based or a portfolio adjustment type of strategy. So one of the things that Brookstone has done, and they said early in the year when we were talking about it, they said, look, we will probably see a correction or an adjustment of portfolios of 10 to 14%. The average has been 14%. The first quarter actually was down 13%, but before it rallied back at the end of the quarter. So it's just it's doing, the market's going to do all the news with Ukraine and Russia and inflation. Overall, the feeling is it's actually done pretty well and sustained. But as we've talked about, that in the future we have to just start to see any unwindings, being nimble to be able to start to have strategies where we're not, say, heavily in the growth area or heavily into the bond area, as we've talked about in the past. And then, you have your volatility index here, and you can see that, obviously the first quarter was very volatile. It's pretty much, I've said this in the past, that volatility is here to stay. Not only did we have this, Mark is suggesting that we might see two more rapid fluctuations within the course of the next year, right? Similar to, say, 2018 or 2015, going back to, typically there's 2 to 3 within a year when we have this kind of market pullback. So keep that in mind. We are going to see swings. I mean, the market started off this morning down to 100. They finished up 100, right? You just, I always will tell clients that stop watching the news, right? Because again, they have to report news. They have to the markets operate on fear and greed. And, as an advisor, I try and help people manage emotions and say, look, we have to have strategies in place that weather storms like that. So, just having that comfort hopefully will allow you to sleep a little bit better at night. So this was my call today. Again, I know it was probably pretty quick. I may not have even made it 15 minutes. Again, I didn't put all this information together, but I am parroting a lot of the data that was there. We will have this posted and a recording. So if you want to go back and review it, happy to do that. And again, if you have any questions for me, always feel free, reach out. There's my contact information. And for those of you that don't know, Caitlin Urchik is my right-hand lady, and she is back from maternity leave. She had her third child. And so if you haven't welcomed her back, make sure you do. Send her an email at caitlin@professionalplanningservices.com. Thank you, everybody, for hopping on today. And again, if you have any questions, reach out, and I'll talk to you soon. Bye-bye.